Welcome to the Making Money in Multifamily show, where we discuss everything to do with multifamily real estate investing. We believe it's the best way to gain financial freedom and build lasting wealth. This is where you'll find the best information and practices to help you succeed in your real estate business, whether you're already experienced or just starting out. Here's your host, Dave Morja.
Hello, listener, and welcome to the show. My name is Dave Morja, and with me today, it's actually a Between the Seats series show, and it's Rob Beardsley with me, so welcome back on the show, Rob. And we're going to be on talking about some investor hurdles and different types of structures you can do to set up the deal, basically to align interests between partners, whether it's a general partner, a limited partner, so making sure everybody's on the same page, and basically the pros and cons to all the ways you can set up this type of thing. So Rob, let's just get into it, I guess. Let's just take kind of a cookie cutter example of a deal that you're seeing a lot these days, and maybe we'll just dive into the dynamics of that and kind of shift it around. So
yeah, we'll focus on preferred returns and how they're treated in different deals. So as most people are familiar in more retail multifamily syndications, the preferred return is often a cumulative non-compounding hurdle rate, and excess cash flows above the preferred return are then split at the promote level, which, let's say typical deals have an 8% preferred return. And let's say a deal is doing very well and cash flowing at 10% and you're at a 75-25 split. You'll take the cash flows above the 8, those 2%, and you'll split that 75% to investors, 25% to sponsor. And that'll happen continually on a cash flow basis.
And then again, the cumulative, Rob, you just want to explain that part too?
Yeah, I mean, it's pretty simple that anything that isn't paid in a certain period just accumulates to the next period. But like I said, it's often cumulative, non-compounding. So right. There is no penalty assessed to the sponsor or a deficit created for missing pref payments, except just the accrual of it. But there are situations where the pref is compounding, or a similar structure which has an IRR hurdle, which the IRR calculation by definition is a compounding rate of return.
It's going to make you catch up a little bit more.
Yeah, if you miss the let's say you have an 8 pref and you only pay 6, the 2% that you miss will now accrue interest at the preferred return rate of 8%. So not only will you owe that 2% in the next period, but you'll also owe 8% on that 2%.
Yeah, and that's against that basic cumulative approach where if you only paid out a 6 on an 8 pref, you would owe that 2%, but there wouldn't be any penalty for that as far as an IRR hurdle goes or anything. So say, in January, you only paid 6, February, if you ended up with 10, you would just pay the 10 to make up for the 2 that you lost in January. So nothing crazy there as far as that. So yeah, that makes a good point where you're not being penalized as a sponsor if you're going to have, an aggressive approach to say the turnovers or anything like that of the property or basically any business plan to be able to, get the investors their consistent flow of cash. So I guess what are your thoughts with that type of approach or those two approaches?
Yeah, so it's being able to promote ongoing cash flows as well as having a non-compounding preferred are advantageous to the sponsor. And that's why you see a lot of it.
Definitely.
Because syndication has grown a lot in popularity, and there's a lot of sponsors, but there's also a lot of capital that wants to be invested in these deals. And so especially in the retail world, sponsors really have a lot of control in that market. So that's why you're seeing those terms. But traditionally, in private equity and in more institutional real estate and multifamily deals, you'll see IRR hurdles, or they may not always be called IRR hurdles. They could still be called preferred returns, but it'll be actually the promote will be subordinate to a return of capital and the preferred return, which works and acts like an IRR hurdle. What that means is if a deal, like we said before, has an 8 pref, but cash flows at 10%, the excess cash flows, that 2% above the 8, is not going to then be split at the promote rate. It'll just be all given back to investors. And so the 8 will pay investors their pref and maintain the pref as current. And then the 2 will reduce investors' capital account. So if investors invested $1 million, let's just say, and that 2% additionally is it's given back to investors. It reduces their capital account down to 980,000. So now their following year, technically they've only have 980,000 left in the deal, and that 8% actually is based on the new 980,000. So in this different structure, investors like it because they know that the sponsor isn't going to make a promote on their investment, on their money, before they receive all their money back and an 8% IRR or whatever the hurdle rate is. So sponsors like that because in the typical scenario, let's say you have a deal because of IO juicing the cash flows, you might get 10% cash on cash, and then the sponsor's earning a promote. But then let's say the following year the IO goes away, and now you're only cash flowing at 6. But then there's no penalty for that, and there's no clawback for the promote that was earned for doing well before.
You took money from debt basically at that point, right? Your IO. So that's where as a sponsor you were taking money from. I mean, it's in the NOI obviously, but it's a NOI that isn't permanent just by default because that interest only period is only going to be, a year, 2 years, 3 years, maybe more if you're lucky. But by default, that's not the long-term NOI of the property. So, one could argue taking that money is almost, a little bit, aggressive for the sponsor to be able to do that. So yeah, there is validity to that. And I guess back to the IRR promote, it's interesting, you're talking about if you had 2% over a pref where you're basically reducing the cost basis or the investment basis of the investor's money. So yeah, there is that scenario where you're really as a sponsor just trying to get to that exit, whether it's a refinance or a sale. So where's the alignment of interest there versus this other play? I mean, it definitely is different kind of strategy for the sponsor to want to get out of this deal versus, being happy with some cash flows throughout the life of the property. So.
Right. We already know that the traditional multifamily syndication structure definitely encourages sponsors to sell rather than hold. Because if you're sitting there on a big promote because you've raised, you've done a value add and you've raised the value, you've got built-in equity that you could monetize through the promote, you're going to want to sell. But if you do get promoted cash flows, maybe you refi and now you're cash flowing at 20% and you're paying your investors 8 pref, and then you're getting
more promote.
You get a nice promote that could keep a sponsor in a deal for longer, and they may decide to just hold the deal because they get the promote from ongoing cash flows. But in the IRR hurdle, in the more institutional structure, that doesn't exist at all. So even more so, it exacerbates the reality that sponsors will want to exit sooner rather than later to monetize their promote. And that could be a good thing or a bad thing. I think that well aligns with institutional money because typically private equity and other investors of that nature have timeframes on their capital. That could be 3 years, 5 years, 7 years. They want to get out. So if the sponsor, they want to make their money and get out, that's fine, because as an LP in the deal, you got the protection of the IRR hurdle that, hey, unless things go really bad, I know I'm going to make my 7 or 8 pref, and it may have to come out of what the sponsor thought he or she were going to make, but at least I'm being made whole on that money, and that's what they're solving for. But on the flip side, I know there's a lot of investors out there just looking for good cash flow, and they don't look at these deals as opportunistic plays to get mid to high teens IRRs. They're just saying, hey, I only make 1 or 2% in my bank account, and I would like some more serious cash flows, and looking at it as a cash flow vehicle, right? And that will not end up working out, because if you have a long-term look and your sponsor wants to earn their $1 million promote, they're going to sell the deal.
They're going to get out of the deal.
Yeah, you could say, oh, holding the deal, it's good market, it's good investment. No, they need to get out. So it's definitely an interesting thing, and sponsors need to find creative structures to truly align their interests so that they can create a product that makes sense for investors to hold deals longer term.
Yeah, that makes a lot of sense. I mean, you're talking from an investor's perspective, really just goals. And like you said, somebody who just wants basically a note that, they're earning a certain percentage on their money year after year, like you said, better than their savings account. Yeah, you probably realistically want to be in that deal for way longer, because why would you want to go through the headache again of finding another deal? So that hurdle structure where you're incentivizing the sponsor to get out so they can get paid, that just seems like a clash of interest. So if you're going to be vetting these deals and you're, a investor that is looking for something like that, you just have to know basically just fundamentally what is that sponsor incentivized to do in this deal? Where are they earning their money to, be able to keep their business going? Because it's not just free money. They're not doing a free service, right? As a sponsor, they're looking to grow their business and have to be, their tables filled and their bellies fed. So it's really just, what makes them tick so I can help me tick. So it's a lot there too. And way back, Rob, we talked about the hurdle and versus the pref, and you said maybe it's at 8% hurdle with the pref. Is that going to be something that's common, or where is that hurdle for a deal like this if you're talking about, outlaying the structure?
Yeah, I would say anywhere from 6 to 10%, which is obviously a big range, but It depends on the risk profile of the deal as well as the market, right? Investors will take whatever terms they can get. It just depends if it's a, investor market, sponsor market, who commands the terms. But today I'd say most commonly is an 8% preferred. And what's interesting, if you're a sponsor and you're thinking, well, how can I differentiate myself and potentially, make it easier for myself to raise money with my investors, you could consider the IRR hurdle structure. Obviously, a lot of people are, and I don't want to say getting away with it, but a lot of people are structuring their deals with, promoted cash flows, which we've done before, and it makes a lot of sense, and there's definitely an argument for it. But given that most deals don't cash flow more than 8% today, you have to be doing, either you have some nice interest only, but that always runs out, or you just have to have a home run deal. But really, most deals are that we're seeing cash flow at anywhere from 7 to 9%, the good ones at least. And, why should I, as a sponsor, really try to negotiate a little bit of promote on 100 basis points of cash flow every year? That's going to result in maybe $20,000 to $50,000, where instead I could forego that and then pitch to investors and say, hey, look, the way my structure works is I'm not going to make a dime on my promote until you've made your IRR, which means you've got all your money back that you originally invested, your risk's off the table, and you've received your minimum return, which you should be very comfortable and happy with, a 7, 8, whatever that number is. So I think that really helps with raising capital.
Yeah, and that actually brings up a good point too, is all these considerations, alignment of goals, but also just where we are in the market to accomplish those goals. So you talk about how these deals are not cash flowing enough to even really make these promotes worth it. And yeah, that makes sense. So why are sponsors, in certain deals trying to force that structure when maybe it doesn't even make sense to consider it to begin with? So like you said, if you're earning pennies on the dollar on this deal monthly or yearly as a sponsor, just because there's not much, delta above that pref on the cash flows, then why not just pivot the structure and make it so that instead of worrying about that money today, you're more worried about that payoff in the future. And as long as the deal, pencils out, that makes a lot of sense to just structure it that way.
Yeah, and as a sponsor, you could look at it in the way that if you are performing on the deal and you're current on your pref and have cash flows in excess of the pref to be able to pay down investors' capital account, investors are super happy, right? They get all the cash flows of the deal. So what's actually interesting is in this scenario, investors get better cash flow than if their cash flows were promoted, right? That just makes sense.
Of course.
So even though these deals are unlikely to be longer term holds just because of the structure, they actually will be getting better cash flow. So that looks a lot better, right? If you can tell your investors, look, the cash flows, look at the 5-year cash flows, they look pretty favorable. But on the sponsor side, you're paying the investor's capital account down. And what that means is upon a sale, when you return their capital, if they originally invested $1 million, but you did a good job paying down the capital account, it might only be $800,000. So now that extra $200,000 is then waterfalled into your promote bucket, which on nominal terms as a sponsor, you'll make more money than less upon the sale because you're not returning as much capital back to investors because you're basically shifting cash flows from the future to the present to investors, which makes them very happy. And as a sponsor, you just have to basically eat the negative value on a net present value basis.
Yeah, you're kind of eliminating that cash flow today for the upside of, if the deal, really hits the sale or whatever, that you're going to make a better buck in the future, which, it's just what a lot of the deals we see today are almost making you push towards is
That's how they look anyway.
Yeah. I mean, that's just kind of what it lays out as, is these don't make sense to worry about, these different splits and everything, and really just worry about the performance and towards the exit of the deal. So I guess, is there anything else you wanted to cover before we kind of get into the nitty gritty of this?
So what's interesting is for longer term holds, right? You're seeing a lot of people buy deals today that even without this IRR structure, they're looking at it. They're not really going to make much promote on cash flows, but they may not sell either because there's just not a lot of value accretion because you're paying top dollar, right? A lot of deals are fully priced. So there you have, you could call it an issue of sponsors buying deals for the fees, the acquisition fee, the ongoing asset management fee. But this is not, it doesn't necessarily have to be a bad thing. Sponsors buying deals, quote, for the fees, isn't the end of the world. You have situations where a sponsor has built a platform. They own lots of properties, they operate the properties, and so they've built an operating company essentially. And so for them, if the structure makes sense for the investors where the fees are reasonable, right? You're not charging value add level fees. Like if you're pitching the deal saying, hey, this is a home run deal, which is why I should be able to charge these high fees and this high of a promote, that's a different issue. But if you're coming to investors and saying, hey, this isn't a home run deal, this is just an addition to my ongoing strategy of, call it core plus, which is not necessarily value add deal of buy it, fix it, sell it, value creation. It's an operating business. We're going to cash flow. You're going to receive all the cash flows because this is an IRR hurdle. I think that's a great place to be today. And if you have the investors and you can honestly raise the money and you can say, hey, we're not buying home runs because they're few and far between in today's market. Deals are fully priced, but we're scaling an operating business and we're going to give you all the cash flows and you're in a safe spot there. I think that's a reasonable thing to do.
Yeah. I mean, you're talking economies of scale here basically, right? So why stop acquiring if you can make it cheap enough for investors and incentivize them enough and it's safe enough for them, all the metrics they need to hit? Why go away from that even if you're going to get paid less? Because you're going to get some guarantees, like you said, through the operational side of the company where, if you're vertically integrated and you have all these great tools at your access, why not get paid for those things because you are able to deploy them? I mean, it just makes sense to be able to do that if you can continue to do so. So yeah.
Yeah. I mean, depending on when this goes live, we've either rolling or have rolled out our in-house management company. So like you said, vertically integrated, that's that magic word. So if you have a vertically integrated business, you as a sponsor are going to make money from your acquisition fees, your asset management fees, and your property management fees. And that is, enough to support your business and to actually, like you said, create the scale to make that profitable. So as a sponsor, you don't need to get the big promote pops to make this business profitable. And at the same time, you can be doing a good service for investors who are looking for that cash flow and maybe struggling to find it in these deals where, you have to buy into deals with sponsors that are value add driven. So they're going to sell quicker. And when you're buying value add, you're taking more risk. You might be buying in at a 4.5 to a 5.5 cap rate and suffering in your cash flow. Whereas on the flip side, if you're buying more for the yield scenario for longer term cash flows, you might actually get better yields from less risk.
Yeah. I mean, it just makes a lot of sense. If there's other ways in your business that the sponsor can profit, it just inherently makes them less incentivized to kind of, rake the investors over the coals or whatever you want to call it to be able to make their money, because there's other ways for them to be able to, make their business work for them. So yeah, that's a great point as well.
Yeah. I mean, we started this about structure and then it kind of got into strategy.
That's okay. It's all about, just let the conversation flow. So I think we'll probably, let's cut back to the second half of the show where we're going to basically pause the video and get into the Excel spreadsheet version of it where we're going to underwrite and basically just play with these numbers. And like I've said before on these episodes, we're just going to probably just blanket numbers, nothing actually really particular, probably dramatize numbers so we can really see these shifts and talk about these structures that we were just talking about. So yeah, stay tuned. And if you're listening on iTunes or whatever, maybe take a pause and pick it up on YouTube, and we'll make sure that's in the show notes for you to watch. So here we are. We are now in Rob's actual underwriting spreadsheet where he, pretty much puts any deal through his model to see how it pencils out. And this is just the summary page. So I guess let's just get into it, Rob. Where do you want to start?
Yeah. So here's the setup. We have a hypothetical $10 million deal. It's a steal of a deal at $50,000 per unit. And we've got projected project IRR of 16.7. The deal is offering a 7% hurdle or a preferred return, however you want to look at it. And over the life of the deal, we're going to average 8.1% cash on cash. So we're actually going to have cash flows that are higher than the 7% hurdle rate. So we should be able to actually give investors some return of capital, but you can see in year one, we actually have a deficit. So we'll see how that works in the waterfall model. We're going to just focus on the waterfall today and see how the cash flows flow through the waterfall in the IRR hurdle scenario. And just to recap from our previous discussion, the way this works is the preferred return is paid. Cash flows above the preferred return are then returned back to investors, and they're treated as a return of capital. So the preferred return is a return on capital. Cash flow above it is a return of capital. And that's different than in a more traditional retail syndication where the cash flows above the pref are then promoted and split, and there's no return of capital until a capital event.
Yeah, so to water it down on a performing property, basically, when it does well and better than expected, you're going to be basically returning the dollars to the investors, and they're going to have less stake in the deal.
Yeah, so let's see how that works. So here we're going to go to our, we don't have to worry about all the stuff happening on the unlevered basis and things like that. But here's our adjusted net cash flow for waterfall. And this is what's going to flow through the partnership. So you can see starting out in year one, the investors have a capital account of 3.1 million, and a 7% return on that 3.1 million is 221,000. What actually gets distributed, as you recall, was I think 6.2 or 6.7%. So there's a definite shortfall there. So you can see tier one distribution is shy of the hurdle, so about 25,000. And what happens then is your end of period capital account grows by the deficit amount. So now technically investors have invested $3.2 million into the deal instead of 3.15 because of that shortfall in year one. And what you see then is starting in year two, that end of period capital account becomes the beginning period capital account. And you can see now that 7% hurdle, it's the same percentage, it's still 7%, but it is now greater than year one's hurdle of 221,000. It's just slightly larger at almost 223,000. So as a sponsor now, you're in the hole. It's a deficit. It's a compounded deficit. You need to make up for it. But as you can see in our hypothetical deal, we are executing on the value add. Already in year two, our distributions are now higher. We've caught up the pref from the previous deficit, and we're returning excess cash flow. So, and that shows up as the end of period capital account is now less than the beginning. Still greater than the beginning of the investment at 3.15, but we're getting there. And then as you can see, we'll just trace it through to year three. That becomes your starting. The hurdle is just slightly reduced, and you're paying in excess of the hurdle. So now your end of period is then further reduced. So that's how the IRR hurdle works here to actually solve for. And we have an IRR check of 7. So investors are getting their 7%. And when you return capital in year 5, you're actually returning, what is this here? I guess that's slightly larger. So maybe you still need to return more to hit the 7% because you actually need to return the cash flows of that year plus the return of capital. But the point is the return of capital is less because you've been able to pay down the capital account through the investment. And what that means for the sponsor is you can see the promote goes into the next period. No promote is earned until investors have received all their money back and their 7% hurdle. And then the sponsor is making $509,000 in promote upon the sale. So we can quickly switch now. Instead of being an IRR hurdle, it can be a preferred return hurdle. and we can see how that changes the cash flows. So just to quickly show you, to prove that it's now being calculated differently, the promote is not being only collected upon sale. It's actually being collected ongoing through the excess cash flows. So if we trace it back here to the hurdle, tier 1 hurdle is 223,000. Tier 2 distribution is exactly that, because we actually have more money. So we can meet in the preferred return period, we can meet that hurdle. And then in tier 2, we have cash flows remaining, just $6,000 remaining, which flow to tier 2. It's the next bucket, which then splits at the 70-30 rate. So you can see investors get the 70 at 4,000 and the sponsor gets 1.7 thousand as their promote. So that's how ongoing cash flows are promoted in this waterfall scenario. And you can see when they sell, the sponsor's only making 472,000 instead of the 510, I think it was.
Right.
So you're making more dollars on a gross basis because you're able to, these monies here, instead of getting promote, those were going towards paying down the investor capital account. So as a sponsor, if you're willing to forego your promote until the capital event, you'll make more money on a nominal basis, less money on a net present value basis, of course. So it's a trade-off of how you want to structure your deal, and then what are your investors willing to accept in terms of promote structure. So that's what we really wanted to show. Is there anything else we should go through?
No, I just think just to recap that waterfall, you could see with those distributions, it really can compound either good or bad, from whatever perspective you're looking at, right? If you're the sponsor and you all of a sudden are short, now you're going to be even more short until you, like you said, got that value add to bump you over to the other side of that equation where you're above the 7. So yeah, those are some considerations to take as well. And then just comparing that to what you see now, you have the more consistent, cash flows for that pref. It's 222.7K a year, just through that deal. It makes for some simpler math, but obviously, like we've talked about, there's a scenario for everything to apply. So that was a great recap, Rob, and definitely a good to, look at the numbers. And if you have something in your spreadsheet like this where you can, swap back and forth and see, like you said, the net present value, and see as a sponsor what makes sense for you and what's going to make sense for the investor, that definitely helps a lot to have those tools at your disposal. So.
Yeah, and we can, we're doing this on the spot, so if we have to set some things up or make some mistakes, so be it. But I'll show you my NPV calculation for the sponsor. It's pretty interesting. So we're looking at a discount rate of 20%. So we're taking future cash flows and discounting them back to present value at a 20% rate. And then something I do for myself also is I discount the promote, because there's a lot of uncertainty in promotes, right? Promotes are a levered number, subordinate to the investor's returns. And so I say, well, if I'm projected to make a certain amount of promote in the future, I'm going to take a discount because it's number one in the future, and number one, it's very uncertain. It's based on my performance. So
less guarantees. Yep.
Yeah. Here, fees are more so guaranteed. So here I have a 30% uncertainty discount, but to keep the numbers simple, let's just put it to 0. And so what you can see here on a NPV basis, your sponsor compensation here in the preferred return strategy, where you're actually making money ongoing out of the cash flows, is a 12%. Well, let's not use the percentage points because it's complicated, but let's use this number here, which is 421,000. On a net present value basis, you're making 421,000. So now I'm going to switch it to the IRR, and you'll see that 509,000, I think it was. Let's see where it is. It's right here, 510,000. Discounted though, 5 years from the future, it's going to be less than that previous number. So you see here, 518,000. I forgot, what was it before?
It was pretty close to that, I think.
It's close? Okay, so not a huge
But then
difference.
you add in the uncertainty and everything too. It's, it's basically a different risk for a sponsor to do, the IRR versus the promote all the way through. So yeah, very interesting.
Yeah, not a huge difference in this scenario. And again, we're doing this on the spot, so we'd like to make more dramatic results happen, but this is more nuanced just because the promote out of cash flow is modest, right? There's just not a whole lot happening. So it doesn't, it's not dramatic with the numbers. But if you had a big refi and all of a sudden you were cash flowing at 20, 30% and you were foregoing any cash flow from promote, that would be a huge change in the numbers because the sponsor isn't receiving, a significant sum of promote because the cash flows are so high. So like we talked about earlier, today's deals, cash flows are, lucky if you're hitting the promote and have much left over. So something to think about.
Yeah, very cool demonstration of how that works. I think that's about what we have for this one. So stay tuned for the next one. Thank you for listening. This has been the Making Money in Multifamily podcast. If you have any questions, comments, or would just like to connect, please feel free to check out the show notes for how you can connect or visit longviewacquisitions.com.